This should be a fun video today. I want to talk a little bit about the red flags that we see on social media. This can be, very pronounced on TikTok specifically, but you also see it on Instagram Reels and YouTube Shorts and pretty much all over the place. And if there's an opportunity to exploit the market from a financial perspective, these are definitely going to be some of the places where a lot of people that are maybe not as savvy or are looking for the quick fix or the quick hit might go for some of that financial advice. So I'm going to dive into this, and this is just where we want to make sure that you are being aware of what is out there. And it's not to say that all of these things are absolutely bad, but if you do them with a level of misguided approach or without the proper knowledge, and you think that it's going to be, a fast, easy fix, then I think you're going to get into some bad water, or some hot water rather. So the first is day trading as a way to get rich quick. Man, I've seen this so much, and it's really become very apparent to me really since the pandemic. So in the summer of 2020, we saw an influx of day traders and people that thought that they could just take the market by storm. And this was, part of the meme stock era, all of these, Reddit threads and things like that, where people are day trading and talking about options trading and all of these crazy things that were really, good at the moment. And frankly, probably the results were really strong. And in fact, I have a number of very close friends that during the pandemic, they got sent home, they had extra time on their hands, and they had more money than they needed. So they just threw some money in the market. They started doing some options trading. They started to do some day trading, buying and selling really quickly, and they looked like geniuses. And I remember having a number of conversations. I was at a bachelor party one year. This was a couple of years ago, and we were talking around, and these guys have just been in the markets for a couple of years, and they were talking about how options are, their option strategy, and that they're doing all these things. And guess what? The market was kind of just doing this, and they were taking advantage of a strong bull market. So they were confusing a bull market for intelligence. And believe me, I've seen it time and time again. And that's why for somebody like me, it's been humbling to be in the markets. I've been doing this for 15 years, and it's really challenging. And when you think that something's going to be just so simple, then you're losing sight of actually the challenge that's involved. And frankly, you're not actually giving it the credit that it's due. So as an example, day traders, the professional ones, do this day in and day out, and they've probably done this for years and years and years, and they have a trail of blood that they can show you as far as times that it wasn't as successful. And so one of the things that you just have to be aware of is if you're going to be doing this type of strategy, you want to commit to it, and commit to it for the long haul. So not only can a bull market mask your lack of knowledge and skill, but also you have to be really attentive to these things on a day in and day out basis. So you've got to be really focused, and you've got to be committed. One of the guys that I was talking with, a good friend of mine, just got overwhelmed over time, and that he felt like he actually couldn't take a break during the day or during a period of time, because he had all these options that were expiring at different points and different intervals, and he was constantly concerned about where he was with the shorts and the longs and this and that, and it was like incredibly stressful for him. And he was asking me, like, why are you not stressed out? And it's really becomes down to the investment strategy that I implement for both my family as well as my clients. Really aligns to more of a long-term trend. We're not necessarily as worried about the day-to-day fluctuations of the market. So that's the first one, is just be very considerate of day trading as an investment strategy to get rich quick. The second thing, leveraging credit to invest. Now, this can come in the worst part, to use credit cards or personal loans to invest. Maybe on the other side is to tap equity in your house to invest in something that's pretty volatile, like the stock market. In fact, I think there's regulations in my industry that discourage and actually outlaw that I can't recommend a client to take money out of their home equity and invest in the market, specifically if it comes to investing with me. I talk about a conflict of interest. Now, that's just something that was born out of a lot of different market cycles, and so that's I think part of the regulations. However, these TikTok influencers, the financial influencers, they aren't necessarily tied with the same regulation. So they can kind of say whatever they want. And so leveraging credit to invest can be a very tricky thing. Now, leverage can help you upsize your gains. So think about, you see this in real estate a lot. A lot of the times you can use margin on your brokerage accounts. So if you have a brokerage account, let's say you had a $100,000 brokerage account, you can actually use margin, which is borrowed money. You got to pay interest on it, but you can then invest, so that can actually increase your returns. But this is where things can get really sideways. Let's just say you borrow a bunch of credit or a bunch of your equity from your property, from your primary residence. Let's say you borrow $500,000 against the property and basically leverage it as much as you can. And then you put that in the stock market, and the stock market loses value more, like by significant amounts, 30, 40%, which is not unlikely, because if you're borrowing money from your primary residence, the equity of your primary residence, to then invest in the stock market, it's likely that you're very much of a risk taker and seeking that risk. So the strategy that you're probably going to be employing or deploying is not going to be one of more conservative using bonds. It's going to be probably 2xing or leveraging the market, so the volatility on that can be very high. And I have heard unfortunate scenario. In fact, a client of mine that's still a dear client of mine had an ex-husband that borrowed a bunch of money from their home, and actually not only did they not invest it, they gambled it away. So they thought, so if you're looking at that kind of almost in the same way, Warren Buffett was famous for saying that in the short term, the stock market is a voting machine. So it can go up and down and you have no idea what's going to happen. But over the long term, it's a weighing machine. So whatever the thing weighs, that's what it weighs, right? So the value of a stock on a day-to-day basis goes up and down, but over the long haul, the fundamentals really win out. So when it comes to investing, I highly discourage, and pretty much emphatically discourage, do not leverage your life on credit cards, personal loans, home equity in order to invest in the stock market. Do it the right way. Do it at a slow bit at a time, because you're not going to get that big hit, or it's likely if you do risk it for that big hit, you're going to get hit back on the back end, because it's shocking how the market always wins in the end if you do it improperly. But if you do it the right way, long-term, steady thinking, building it on a strong foundation, you can really reap the benefits of a strong market. The next thing is kind of tied to this, is if you see guarantees or assurances of high returns, and I'm talking, 10, 15, 20% guaranteed returns, that is something that you should absolutely run away with or run away from. Now, I see this with more real estate types of things and cryptocurrency types of things, and some of those. The market related stuff is usually not as, you don't see that as much, just because there's high regulations on this. But if you come across a reel or something like that, and they're saying, we guarantee 15% annualized returns or 30% return on your money, that is probably something that you should be running away from. That's super sketchy, because the devil is in the details. You got to really watch out for these types of things, because sometimes, and most of the time, they are not regulated in the way that the market or some of the literature around using ETFs, mutual funds, individual stocks is. And so you've got to be very careful of this. I've seen this a number of times where influencers are talking about the gains in their Bitcoin portfolios and how they have gone up 30%. And I'll show you how you can get 40%, 50% returns, and without taking on risk. That is something that you should absolutely be very hesitant to go into, and do a lot of due diligence before you even put a single dollar in there. Do not be mistaken, or do not be chasing returns. That can put you down really hard. I've seen it time and time and time again, where people get promised this huge return, and in the end, they either lose all their money, or that it's a fraction of what they were promised, or something to that effect. So when somebody's coming at you and they're promising large returns, you got to be really careful. I am very, very open and honest and transparent with my clients and the people that I work with, that the return, while it might be good in one realm, we've got to be managing risk. We've got to make sure that it's appropriate for them. And also, how does that ultimately work into their long-term financial strategy? So very considerate of those huge promises of big returns. And then the final thing is sketchy tax strategies. My goodness, this is something that I see very regularly. Is you get these entrepreneur influencer types that talk about their businesses, and they start with all you have to do is, and it then rattles off, put your money into this type of thing, and then you do these shell accounts, and then you do this next thing, and then you can depreciate that, and then you flip-flop that, and then all of a sudden you don't pay any taxes. And that is very, very sketchy when they aren't very specific on exactly what the strategy is. And it's, in my case, or the situation that I've seen, is a lot of times it's flat out fraudulent, and that you've got to be super aware of what you're doing. So using a legitimate tax advisor, a tax professional, is awesome. So I partner with a lot of CPAs, enrolled agents, when it comes to working with clients and just making sure that, hey, does this make sense? If we were to do X, Y, and Z, if we were to do some tax planning that involves, moving, it could be as simple as an entrepreneur filing as an S Corp or a C Corp, or should they just stay as a single member LLC and don't have that strategy? What does that look like? What does it look like for a cost segregation analysis for a piece of real estate? So working within the confines of this, because at the end of the day, the IRS is very interested in people navigating or people exploiting loopholes. And what you don't want to do is just get yourself in hot water. You want to do it the right way, go through the correct steps, because there are some things out there that are absolutely helpful from a tax perspective, but it usually involves a lot of work. So if it does seem too easy and it starts with all you have to do is, then you're probably not going to be doing it the right way. There are some things that you can take advantage of that you may not have known about, but that's just education. And so that's where we work with our clients, is to take advantage of HSA contributions, retirement plan contributions. And then we go a step further and look at their plan specifically. If they're investing in real estate, are they taking as much depreciation as absolutely possible? Do they look at breaking their portfolio or the real estate into smaller bites? Like, over a more traditional 27.5 years, do they do a cost segregation analysis where they can accelerate some of that depreciation? And again, this is all within the confines of the tax code, but it's also using a tax professional to ensure that you're doing it the right way. And if you can stay above board, oftentimes it's the best way to do it over the long haul, even if it does feel like you get a little quick punch, a quick hit, a quick win. So these are some of the 4 red flags when I see these on social media, whether that's TikTok, YouTube, or Instagram, or other places, where people are just taking advantage of the system, cutting corners, and frankly getting themselves into some hot water if they don't do it properly.